Hello! Today I'm going to be discussing adjusting entries. Adjusting entries are journal entries that are performed at the end of the period in order to update the balance on many different accounts. Now there are many reasons why accounts will need to be updated through the adjusting process, but we're just going to cover 6 of those examples today in this video. You'll encounter many different circumstances throughout your accounting class where adjusting is required. So the problem says, use the trial balance and the following information to prepare adjusting journal entries for the month. In part A says a physical count reveals that the company has $100 of supplies remaining. So if we come over here, we'll see that the supplies account currently has a debit balance of $700. Now that's different from the $100 count that we have of the supplies. So what we're going to have to do is we're going to have to decrease the supplies account balance by $600, which is 700 minus 100, to get to the correct balance of $100. So that's going to require a credit to supplies for $600. So we can put that into our journal here. Supplies as a credit for $600. And another thing with the adjusting entries is that there's always going to be either an expense or a revenue account that's going to go in each entry. In this case, since we're using supplies, that's going to have to be supplies expense. And that's also going to be for $600. Part B says 1 month's insurance coverage has expired. The current balance of prepaid insurance is for 6 months worth of insurance. So if we look over here, we'll see that the prepaid insurance account has $900 balance. But that's for 6 months worth of insurance. But we want the 1 month version of that, which is just for the month of July. So what we do is we take $900 and we divide by 6 months to get $150 of insurance per month. So each month we have an expense, which is insurance, of $150. So we're going to title that Insurance Expense for $150. And we also have to decrease our prepaid insurance if we're using that insurance. So we're going to use prepaid insurance and decrease that with a credit of $150, since that's an asset account. Part C says that employees have earned $50 of wages that are unrecorded and unpaid as of July 31st. So we know that the employees have worked $50 worth of wages, but they haven't been paid yet. So this is an expense to our business, so we're going to call that wages expense for $50. But since we haven't paid them yet, we're not going to use cash. We're going to use another account, which is wages payable. And that just recognizes that we're going to pay those employees at a later date. Part D says that the equipment is being depreciated using the straight line method with an estimated 3-year life and a salvage value of $140. Now if you remember the formula for the straight line depreciation, you need to take the cost minus the salvage value and divide by the useful life. So in this case, the cost is going to be the balance of the equipment account, which is $3,200. So we take $3,200, subtract the salvage value of $140, and then divide by the useful life, which is 3 years. And if we do that, we get the depreciation per year to be $1,020. But remember, we're doing adjusting entries for just the month of July, so we need the monthly amount of depreciation. So if you take the yearly amount of $1,020 and we divide by 12, that will get us $85 of depreciation per month. So our entry for depreciation is going to be depreciation expense for $85. And then along with that is going to be an account we call accumulated depreciation, also for $85. Now the accumulated depreciation account is a contra asset account, meaning it has the opposite normal balance of what normal assets have, meaning it has a credit balance. And that's going to go to offset the equipment account. So these two accounts are really tied to each other. And this is going to just total up all the depreciation that's been recorded on the equipment. Okay, Part E says the company earned $275 of consulting revenues, which are unbilled and unrecorded as of July 31st. So since this company owes us $275, that's going to be an accounts receivable for us. And since we provided these consulting services, that's going to be a consulting revenue for us. Alright, Part F says the company performed $300 of services for a customer who previously paid in advance. Now, if you have a customer who pays in advance, we usually call that an unearned revenue. But now we've actually performed that work. So now we're going to have to decrease this unearned revenue because now we've actually earned it. So that's going to have to be a debit to unearned revenue for $300. Since we've done that work, that's got to be consulting revenue now, since we've earned that. Alright, we are finished with our adjusting entries. Now just a reminder, there are many different circumstances when adjusting entries are going to have to be made, and you'll learn about many new circumstances throughout your accounting course. And just a few hints if you're struggling with adjusting entries. 1. Make sure you're not using cash in any of your adjusting entries. There are some unique circumstances when you might need cash in your adjusting entries, but usually at this stage you're not going to use cash at all. And the other thing that I already mentioned is that every adjusting entry is going to include either an expense or a revenue account. So if you don't have one of those in your entry, then you know something has to be wrong.